Let's get more to it because we're looking at the balance sheet in a big way.
I want to bring in Robert Schiffman. He's Bloomberg Intelligence Senior Technology Credit Analyst. He joins us here in the Bloomberg Business Week studio. So what are we missing? Because there's a massive backlog here, and that's what investors wanted to see. That signals demand. But why are we seeing so much? And look, I know we're going to talk about credit, but why are we seeing so much concern from investors today?
Well, it's the holiday season, and the market is deciding on who they think is naughty and nice. And clearly we know where Oracle is shaping out right now. And quite frankly, I think it's overdone. I think that this whole concept of panic and bubble and financial crisis and CDS concerns really doesn't take into account the bigger picture of where this company is. So what is the market really worried about right now? So Oracle's growth last night came in a little bit slower than the equity community had hoped for. I think if this was a Microsoft or an Alphabet or an Amazon and they missed cloud growth by 1 or 2%, you'd see similar moves. So what else is really differentiating Oracle? Well, the difference for Oracle is that they've got the most amount of debt out of any non-financial issuer in the high-grade corporate market. They've got $100 billion of debt. And they're spending a lot. And quite frankly, they're spending even more than the market anticipated. They said last night, we're going to spend $15 billion more in CapEx this fiscal year than what we had guided. So they need to borrow a lot of money. They already have a lot of debt. There's a tremendous amount of hedging that's going on that's pushing CDS wider. And quite frankly, it's just a simple story. You need to spend money to make money. You have to spend a lot of money up front before you start collecting that cash. And it's just going to take a little bit of a little while for those revenues and cash flows to catch up to the amount of debt that they have.
So tell everybody, take a chill pill, basically, right? That you think the spending makes sense, and it's just a case of time for it to pay off.
Yeah. So listen, I'm a credit guy, but let's look at the stock for a second.
But credit can tell us so much.
Let's start with the stock. The stock is way off the highs, right? When they announced all these contracts going above $400 billion, the stock shot up. And now we're down more than 40% from the highs. But if we just go back to the beginning of the year, we're still up by 20%, right? This is a $500+ billion market cap company. There's not a reason to panic about that. They've issued a lot of debt. They issued an $18 billion bond deal. There's been discussions about them doing some sort of private deals to fund data centers upwards of $38 billion. That number, quite frankly, might be a lot higher. That could be $50 or $60 billion. And there's reasons behind that because you can do a lot of this through SPVs, do it off balance sheet, and protect your ratings. Oracle was very clear last night. They said it without being asked. We are committed to our investment grade ratings. It makes sense. They should be because you don't want to have a balance sheet that has $100+ billion of debt that you have to finance in the junk market. But I think what it means is there's a lot of different triggers for them to pull in order to protect their balance sheet and to eventually get spreads tighter. Now, we just have to recognize, though, in the very short term, the risks probably do outweigh the reward. You have rating agencies.
How do we know that for sure? Because of the demand and the backlog? Is that what that tells us?
Yeah, well, listen, they added to their backlog by a significant amount. Now they have well over $500 billion of signed contracts. We could debate whether or not they're actually ever going to get paid for that. And I think the market is doing that.
Well, is that the concern?
Well, that is the big concern, that OpenAI, which might be their biggest customer, might not have enough money themselves to pay for what Oracle is building. I think Oracle is starting to try to lay out, if they come, we'll build it. There's a way that you don't have to put all the capital up front. Again, there's a lot of ways to do this from a financing standpoint. A whole rent-a-chip philosophy where they're not actually buying chips, say from NVIDIA.
But does the creative financing just maybe potentially, Robert, just mask, there's still a spend, there's still an expectation. So even if you're creative in terms of how you finance, aren't you still potentially vulnerable if this doesn't all come to fruition?
Well, they're not going
or takes longer?
They're not using the money and buying Christmas and Hanukkah gifts for their employees. They're building assets that are going to generate these revenues and cash flow. It's part of any business build. You're not seeing these same sort of questions in the credit markets about those other big hyperscalers. You're only seeing it for Oracle because they're mid-BBB and people are worried they're going to fall to junk.
So just 20 seconds, what would concern you? What piece of information would come out from the company that you would say, okay, now I actually am concerned about this?
Well, the two concerns would be the rating agencies downgrade to low BBB and keep the outlook negative and give some sort of numbers that might not be achievable. And two is when Oracle comes back in 3 months or 6 months, and we don't see the type of growth that we're anticipating from their cloud and infrastructure businesses.
So every quarter we get a check.
You got to check every quarter.
All right, good stuff. So appreciate it. Robert Schiffman, he's Senior Technology Credit Analyst at Bloomberg Intelligence right here in our studio.